Okay, let's just jump right into it. Today, we're going on a comprehensive 10-chapter journey, exploring the massive macro and micro forces that are actively shaping our world and our wallets in 2026. For this explainer, we're pulling straight from the latest World Inequality Report, along with some heavy-hitting research from places like Oliver Wyman, to map out exactly what's going on in the global economy. We're going to cover everything from the ultra-wealthy at the very top all the way down to the behavioral psychology behind the taps you make on your personal banking app.
Here's the roadmap for our journey today. We'll start with the extreme global wealth divide. Look at those compounding demographic gaps. Zoom into your personal financial psychology. Explore AI and wealth management. And finally, look at some proposed global policy solutions. Let's get into it.
Section 1. The extreme global wealth divide. Let's set the stage with the macro reality of our financial system today.
So, if there's one number you really need to remember, it's 60,000. According to the data, the top 0.001% of the global population is made up of fewer than 60,000 multimillionaires. Just picture a single football stadium. You could comfortably fit every single one of those people inside.
And here is where it gets absolutely wild. The adults sitting in that one hypothetical stadium control 3 times more wealth than the bottom 50% of humanity combined. We are talking about 2.8 billion people. And since the 1990s, the wealth at the very top has just been accelerating, while the bottom half share has basically been stuck at around a tiny 2%.
Now, this isn't just about a few individuals getting lucky. Researchers point to something called an exorbitant privilege. Basically, international financial structures systematically lean in favor of wealthy nations. To put it in numbers, rich countries extract roughly 1% of global GDP every single year from poorer nations through things like debt service and profit repatriation. That is literally triple the amount of global development aid flowing the other way. The report is pretty clear here. This isn't some random accident of the market. It's a structural advantage built by political design.
Section 2. Compounding gaps across demographics and geography. Let's zoom in a bit and see how these massive global trends actually hit the ground.
You can see the compounding impact of systemic barriers really clearly in the U.S. The median net worth of a white household without disabilities sits at over $255,000. But if you compare that to a single black householder with a disability, their median net worth is a shocking $1,951. That is a staggering gap where the white, non-disabled household holds over 130 times the wealth.
We have to remember we aren't just talking about abstract numbers on a spreadsheet here. These are real human realities. The research highlights how intersecting factors, like race and disability, can lock people out of economic empowerment. People in these overlapping marginalized groups have much higher unbanked rates, meaning they often have to rely on alternative, predatory lending services. It creates these incredibly dense layers of financial discrimination that are just so hard to break out of.
Looking geographically, the World Inequality Report neutrally highlights what it terms India's billionaire Raj. The data documents that the top 10% of the population there owns 65% of the nation's wealth, while the bottom 50% holds a negligible 6%. So, despite India seeing massive overall GDP growth, the income share for the bottom half hasn't really budged. It's a prime example showcasing how high economic growth doesn't automatically equal shared prosperity.
Section 3. Psychology and smart money traps. Let's zoom all the way into your personal experience. How on earth are we supposed to navigate this?
Traditional finance loves to assume we're all perfectly logical robots, just taking in data and maximizing our wealth. But behavioral finance proves our emotions and mental shortcuts actually sabotage us. Our own brains work against us. We get overconfident. We suffer from loss aversion, where losing $100 hurts way more than the joy of finding $100. We anchor our expectations to past prices, and we blindly follow the herd, even when the herd is walking straight off a cliff.
And those mental blind spots make us huge targets for smart money traps. Financial researchers point out a massive one for 2026, the illusion of quick money. We are seeing major investment shifts, especially with Gen Z on social media platforms like TikTok, chasing promises of high returns with almost zero risk. These stories prey on our sense of urgency when we feel behind on our goals. But look, if you can't simply explain how an investment actually makes money, it's highly likely a trap that could absolutely wreck your hard-earned savings.
So, faced with this highly complex, unequal global market,
and our own irrational brains, you really have to ask, how does an investor even survive in 2026? What tools can actually protect us from ourselves?
Section 4. AI in Wealth Management. This brings us to the technological revolution happening right inside our pockets.
By 2026, AI is definitely no longer sci-fi. It's a highly functional partner. We're seeing advanced machine learning from the broader markets trickling straight down into our personal apps. AI is analyzing insane amounts of data to build these unified client brains that actively manage our daily financial lives. We're talking automated budgeting, real-time portfolio rebalancing alerts, complex scenario modeling for retirement, and instant fraud detection. It's essentially automating away the mental heavy lifting of daily finance.
But, and this is absolutely crucial, the key isn't just handing your wallet over to a robot. Industry experts stress the massive difference between blind trust and automation and using platforms like Origin that actually ground their AI reasoning in strict compliance and transparency. True financial resilience means using AI responsibly, with regulatory guardrails that protect you from both market volatility and the AI's own potential blind spots.
Section 5. Solutions for a fairer future. Let's pull back out to the macro view. If inequality is as extreme as the data shows, what do the experts say can actually level this massive playing field?
Well, to fix the wealth gap, the data screams that we have to close the human capital gap first. Just look at this educational chasm from the report. North America and Oceania spend over 9,000 euros per child every single year on public education. In sub-Saharan Africa, that figure is just 220 euros. That's a 1 to 40 difference in educational spending. That kind of disparity literally cements inequality across generations, basically ensuring that where you're born largely dictates your economic destiny.
To tackle these massive shortfalls, the World Inequality Report neutrally lays out a roadmap of policy solutions. Step 1. Enact a modest, progressive 2% global wealth tax on ultra-rich multimillionaires and billionaires. Step 2. Create a global financial register to track assets and curb tax evasion. And Step 3. Aggressively funnel all those investments directly into universal health and, crucially, closing that massive global education gap.
I think this quote perfectly sums up the core thesis of all our sources today. Inequality is not a law of nature, it is the product of laws and policies. The extreme economic divides we're looking at, from the global exorbitant privilege down to the local gaps driven by race and disability, they are political choices. And because they are choices, they can be rewritten.
So as we navigate the rest of 2026 and look beyond, we're really standing at a crossroads of rapid tech advancement and historic wealth concentration. The big question we have to ask ourselves is, how will we use these new tools and policies? Will the financial future belong to the automated, ultra-wealthy few, or will we choose to build a system that empowers the educated many? Thanks for joining me for this explainer. Until next time, keep questioning the data and keep questioning the system.
If you like this content, please like, comment and share. Tell us what topic you want to see next. And don't forget to subscribe.